Lord Mayor, ladies and gentlemen, thank you for inviting me to be here today. I wanted to give you, by way of context for some of the work that you've been doing as a group, our experience of changing regulation here in the UK. I propose briefly to cover 4 things: explain our current regulatory structure and the changes to it, explain what we think the impact of those changes will be with a particular focus on competitiveness, and then very briefly conclude with the timeline from here. The current regulatory structure in the UK is one that's based on a single integrated financial services regulator, the Financial Services Authority, with the Bank of England as the central bank and the Treasury as our finance ministry also involved. What the financial crisis demonstrated very clearly to us was that there were questions over who was responsible in a crisis. There had been an underlap for thinking about macro-prudential regulation, risks at the level of the system as opposed to risks at individual firms. And there had been a lack of focus in the integrated regulator. In consequence, here in June 2010, the Chancellor of the Exchequer proposed a fundamental change in how the UK undertook regulation. This diagram, which I shan't concentrate on, just highlights the changes that will be made with the new legislation. It introduces a macro-prudential regulator, the Financial Policy Committee, as a part of the Bank of England. It takes the integrated regulator that is the Financial Services Authority and splits it into 2. The Prudential Regulation Authority, which will be a subsidiary of the Bank of England, which will be responsible for the prudential regulation of deposit takers, of banks, and of insurance companies. And then we also have a conduct regulator, the Financial Conduct Authority, which will be responsible for the regulation of markets, for the regulation of retail and wholesale conduct in financial markets, and the prudential regulation of other firms. Importantly also, we have a focus on systemic market infrastructure in the Bank of England with clearing houses, securities settlement systems under the regulation of the Bank of England too. So what are these changes intended to achieve? We create the Financial Policy Committee as the macro-prudential regulator, focused on the stability of the system as a whole, not just the individual firms and markets that comprise it, but the system as a whole. And importantly, also with the tools to be able to deliver on stability. The Financial Policy Committee makes recommendations and can give directions to other regulators in the system in order to mitigate, to reduce risk to the stability of the system. And this move towards having macro-prudential regulation and a focus on the stability of the system as a whole is something that you can see internationally as well as here in the UK. The second thing I wanted to highlight was the introduction of Twin Peaks and the creation of the PRA and the FCA as separate regulators. Each regulator will have a single objective and will in consequence be a focused regulator. The PRA focused on the safety and soundness of those firms that it regulates, the FCA on the functioning of financial markets. And in addition to being focused regulators, both regulators are looking to undertake focused regulation. Both regulators in their approach are looking to focus on the handful of things that matter to their objectives, leaving financial firms able to run their business elsewhere. What is the intended outcome of this? A stable financial system and financial markets that function well. The PRA will be part of the Bank of England. That will enable financial regulation to be better joined up with central banking, whether that's provision of liquidity to the system as a whole, being the resolution authority, or macro-prudential regulation. There are obviously potential for downsides with these changes. Many financial firms talk about the increased expense and the increased risks of poor coordination with more than one regulator. And that's something that, as regulators, we are looking to take seriously, setting out arrangements so that we work together in an independent but coordinated manner. And importantly as well, we need to think about competition and economic growth. Many of you will have heard the phrase, the stability of the graveyard. In order to address that, the Financial Policy Committee, which thinks about risk at the level of the system as a whole, has an objective, a secondary objective, to promote the government's policies on economic growth. The FCA has an objective to promote competition, and both regulators, both the PRA and the FCA, are to have regard to economic growth in undertaking their jobs. So our aim here is to produce a system where financial markets function well, where the financial system is stable, and one where we have regard to the consequences for competition and for economic growth. What is the timeline from here? Very briefly, these reforms, as I said, were originally proposed in June 2010. We've been operating some of them on an interim, informal basis since then. As it happens, the legislation made its final step out of Parliament just yesterday, and our expectation is that these new arrangements, the legal cutover to the new arrangements, will happen on the 1st of April 2013. So the introduction of macro-prudential regulation and Twin Peaks will be something that we'll be able to see in reality with effect from Easter this year. Thank you.